The United States government has a checking account. It sits at the Federal Reserve. Right now, that account has roughly $700 billion in it. And over the next 60 days, the Treasury Department is going to burn through almost all of it. Not because they want to, because they have to. The debt ceiling is frozen. Congress has not raised the borrowing limit, so the government cannot issue new debt to fund operations. Instead, they are spending down their cash reserves like a family living off their savings account while waiting for a paycheck that may never come. But here is what nobody is telling you. Every dollar the Treasury spends from this account does not just disappear. It drains reserves from the banking system. And when reserves drain, banks hoard cash. When banks hoard cash, lending freezes. When lending freezes, the economy stops. In this investigation, you will learn 3 things that the financial media is deliberately ignoring. First, what the Treasury General Account actually is and why its balance matters more than the stock market. Second, the exact mechanical pathway from government spending to bank reserve destruction to the SOFR spike we just analyzed in our last video. And third, why the current drawdown rate puts us on a collision course with a liquidity crisis by late February or early March. This is not about politics. This is not about deficits or spending priorities. This is about the plumbing. The invisible plumbing that connects the government's checking account to your bank's ability to lend you money. Educational analysis only, not financial advice. This is the story of the account that controls everything. Most people think the government pays its bills by printing money or borrowing from China. Neither is quite accurate. Here's how it actually works. The Treasury Department maintains an account at the Federal Reserve Bank of New York. This account is called the Treasury General Account, or TGA. Think of it as the government's checking account. When you pay your taxes, that money goes into the TGA. When the government auctions Treasury bonds, the proceeds go into the TGA. When the government needs to pay Social Security checks, military salaries, or contractor invoices, they write checks against the TGA balance. Under normal circumstances, the TGA balance fluctuates but stays relatively stable. The Treasury auctions new debt to match their spending needs. Money comes in from bond sales, money goes out for expenses, and the cycle continues. The TGA balance typically sits somewhere between $300 billion and $800 billion, depending on the time of year. Tax season increases it, spending surges decrease it, but it stays in that range because the Treasury can always issue more debt to refill it. But right now, we are not in normal circumstances. The United States hit its statutory debt ceiling limit in mid-January 2026. This is the legal cap on how much debt the federal government can have outstanding. Once you hit the ceiling, the Treasury cannot issue new bonds to raise cash. They are locked out of the borrowing market until Congress votes to raise or suspend the limit. This has happened many times before. It is a recurring political theater. But while the politicians negotiate, the Treasury still has to pay the bills. Social Security recipients still need their checks. Federal employees still need their paychecks. The government cannot just stop. So the Treasury activates what they call extraordinary measures. They use accounting tricks to free up a little bit of borrowing room. They suspend certain investments. They redeem balances early. But these tricks only buy a few months of time. The real lifeline is the TGA cash balance. The Treasury is now spending down the $700 billion that sits in the account. They are burning through roughly $10 billion per day to keep the government running. At this burn rate, the TGA will hit near zero by sometime in March or April. That date is called the X date, the date when the cash runs out and the government faces default if Congress has not acted. Everyone is focused on the political drama. Will Congress raise the ceiling? Will there be a deal? But while the news cameras are pointed at Capitol Hill, something much more dangerous is happening in the financial system. The TGA drawdown is draining reserves from the banking system. And this drain is the invisible force behind the SOFR spike, the repo stress, and the funding crunches we have been documenting. Let's trace the pathway, step by step, from a Treasury payment to a bank reserve shortage. Step 1, the government writes a check. Let's say the Treasury needs to pay a defense contractor $1 billion for a shipment of equipment. The Treasury instructs the Federal Reserve to debit the TGA account by $1 billion and credit the contractor's bank account. This happens electronically, instantly. Step 2, the contractor's bank receives the deposit. The contractor banks at JP Morgan Chase. JP Morgan's reserve account at the Fed is credited with $1 billion. At first glance, this looks like a good thing for JP Morgan. They just received a big deposit. But here's the key detail. This $1 billion did not come from another bank or from the private economy. It came from the TGA. The TGA is a liability of the Federal Reserve, but it is separate from the reserve system. When the Treasury spends money from the TGA, it converts a government liability into a bank reserve. It moves money from one pocket of the Fed's balance sheet to another. Step 3. The total level of reserves in the system increases slightly for the contractor's bank, but decreases for the system overall. Here is why. When the TGA balance goes down, the overall liabilities on the Fed's balance sheet shift. The banking system's reserve balances go up initially from the deposit. But here is the catch. The Federal Reserve is simultaneously engaged in quantitative tightening. They are letting bonds roll off their balance sheet, which drains reserves. The TGA drawdown adds reserves on one side, but QT drains them on the other. The net effect depends on which force is stronger. Right now, QT is running at about $60 billion per month. The TGA is being drawn down at about $300 billion per quarter. So in theory, the TGA drawdown should add liquidity. But it does not work that way in practice. Why? Because of distribution and timing. The reserves created by TGA spending do not flow evenly across all banks. They concentrate in the accounts of large banks like JP Morgan, Bank of America, and Citigroup. Meanwhile, smaller regional banks might not see any benefit. This creates a tiered system where some banks are flush with reserves and others are starved. Step 4. Banks with excess reserves become cautious. You might think a bank with extra reserves would lend more aggressively in the repo market. But the opposite happens. Banks are worried about the future. They see the TGA balance dropping. They know that once the TGA hits zero, the only source of new reserves will be Fed intervention. They do not know if or when the Fed will step in, so they hoard the reserves they have, they pull back from overnight lending, they increase the interest rate they charge in the repo market. This is what drives SOFR higher. Step 5. The liquidity stress cascades. When SOFR rises, as we explained in video number 7, it reprices trillions of dollars in loans tied to that benchmark. Credit card rates go up. Corporate borrowing costs increase. Hedge funds face margin calls. The TGA drawdown, which seems like a simple accounting entry, ripples through the entire financial system. It touches every loan, every derivative, every leveraged position. And here's the part that should terrify policymakers. The drawdown is accelerating. In early January, the Treasury was spending about $8 billion per day from the TGA. Now, in late January, they are spending closer to $12 billion per day. Why? Because tax refund season is starting. The IRS is sending out refunds, which are paid from the TGA. At the same time, the government is making quarterly payments to contractors and vendors. The spending surges during specific windows, which means the TGA can drop $50 billion or $60 billion in a single week. This creates volatility in the reserve system. One week, reserves are stable. The next week, they drop sharply. Banks cannot plan. They do not know what their reserve position will be in 2 weeks, so they become defensive. They reduce risk. They tighten lending standards. This is how a government cash management issue turns into a credit crunch for Main Street businesses and consumers. But wait, there is another layer. The TGA drawdown is not just draining reserves. It is also affecting the Treasury market itself. When the Treasury cannot issue new bonds, the supply of Treasuries shrinks. Dealers who normally buy new bonds to finance in the repo market have less inventory. This reduces the collateral available in the repo system, which can also push rates higher. So the TGA drawdown hits the market from two directions: reserve drainage and collateral scarcity. Now let's look at the historical precedent. This is not the first debt ceiling standoff. In 2011, the government came within days of default. The TGA was drawn down to dangerously low levels. The stress in the funding markets was severe. LIBOR OIS spreads, which measure bank stress, blew out. The stock market crashed. Standard & Poor's downgraded the U.S. credit rating. Eventually, Congress passed a last-minute deal and the crisis was averted. But the damage was done. Borrowing costs stayed elevated for months. Economic growth slowed. In 2013, we had another standoff. Same pattern. TGA drawdown, reserve stress, market volatility. Again, a last-minute deal. In 2021, same story. Each time the financial system came closer to breaking. Each time the assumption was that Congress would act before it was too late. But assumptions are not guarantees. And this time in 2026, the political environment is even more fractured. The negotiations are messier, the timeline is tighter, and the financial system is more fragile than it was in previous crises. Now let's map the domino chain. What happens as the TGA continues to drain over the next 30 to 60 days? Domino 1, reserve scarcity threshold. The Federal Reserve has never publicly stated the exact level of reserves that the banking system needs to function smoothly, but market analysts estimate it is somewhere between $2.5 trillion and $3 trillion. Right now, total reserve balances are sitting at approximately $3.4 trillion. That sounds like a comfortable buffer, but the rate of decline matters. If reserves drop by $200 billion in a matter of weeks due to the TGA drawdown combined with QT, we could approach the danger zone faster than anyone expects. When reserves fall below the threshold, banks start hoarding. Overnight lending rates spike. SOFR goes vertical. This is the September 2019 scenario all over again. Domino 2, Fed emergency intervention. If SOFR spikes above 6% or 7%, the Fed will be forced to act. They will restart repo operations. They will inject liquidity through the standing repo facility. But here's the problem. Emergency intervention sends a signal to the market. It tells investors that the system cannot function without Fed support. This destroys confidence. Stock prices fall. Credit spreads widen. The intervention itself can trigger the crisis it is meant to prevent. Domino 3. Treasury market dysfunction. If the TGA hits 0 and Congress still has not acted, the Treasury will have to prioritize payments. They might delay payments to contractors. They might delay tax refunds. This creates chaos in the economy, but it also creates chaos in the Treasury market. If investors start to believe that the U.S. government might actually miss a payment on a Treasury bond, even for one day, the entire risk-free rate paradigm collapses. Treasuries are the foundation of global finance. Every other asset is priced relative to Treasuries. If that foundation cracks, everything built on top of it falls. Domino 4, money market fund stress. Money market funds hold hundreds of billions of dollars in short-term Treasury bills. If there is any uncertainty about whether those bills will be paid on time, money market funds face a crisis. Under SEC Rule 2A7, money market funds must maintain a stable $1 net asset value. If the value of their Treasury holdings drops due to default fears, they can break the buck. This triggers mass redemptions. Investors pull their cash out of money market funds, which forces the funds to sell assets, which drives prices down further. This is a classic bank run, but in the shadow banking system. Domino 5, corporate cash freeze. Corporations hold trillions of dollars in cash, and most of it sits in money market funds or short-term treasuries. If those instruments become unreliable, corporations pull their cash and hoard it in actual bank deposits. But banks do not have the capacity to absorb a sudden inflow of $2 trillion in corporate deposits. The banking system is reserve constrained. This creates a liquidity traffic jam. Money cannot flow to where it is needed. The payment system seizes up. Domino 6, consumer credit contraction. When banks are hoarding reserves and worried about liquidity, they tighten lending standards. Credit card limits get cut, auto loan approvals slow down, mortgage applications get denied. This is not because individual borrowers are riskier. It is because the bank's balance sheet is constrained. They cannot afford to extend new credit when they are uncertain about their own funding. Consumer spending falls, retail sales drop. The economy tips into recession. And this recession is not caused by weak demand or high prices. It is caused by financial plumbing failure. Now let's talk about the international dimension. The US dollar is the global reserve currency. Foreign banks and central banks hold trillions of dollars in reserves, and much of that is held in Treasury securities or in accounts at the New York Fed. If there is a debt ceiling crisis, if there is any doubt about US creditworthiness, foreign holders start to diversify. They sell treasuries. They buy euros, yen, gold. This drives up US borrowing costs even further. It weakens the dollar. It creates inflationary pressure because imports become more expensive. But here's the paradox. A weaker dollar is usually good for US exporters. But in a crisis driven by confidence loss, the dollar can weaken and the economy can still collapse. Foreign investors are not rotating out of dollars because they found a better opportunity. They are fleeing because they have lost trust. That kind of capital flight is destabilizing. It can trigger a currency crisis, even in a reserve currency. And there is a feedback loop. The TGA drawdown drains reserves, which causes SOFR to spike, which increases government borrowing costs, which makes the deficit worse, which makes the debt ceiling fight more intense, which delays the resolution, which drains the TGA faster. It is a vicious cycle with no natural stopping point except either a political deal or a financial catastrophe. Let's bring this back to your life. What does the TGA drawdown mean for you, practically right now? Consequence 1, watch your bank's reserve position. If you are a business owner or a high net worth individual, you should care about which bank holds your deposits. Not all banks are equally exposed to reserve stress. Large money-centered banks like JP Morgan and Bank of America have massive reserve buffers. Regional banks are more vulnerable. If you have significant deposits at a regional bank, consider whether they have sufficient liquidity to weather a funding crisis. FDIC insurance covers $250,000 per account, but if you have more than that, diversification is prudent. Consequence 2, prepare for credit tightening. If you need to borrow money, do it now. Do not wait until March. If the TGA runs dry and the Fed has to intervene, lending standards will tighten. The mortgage rate you could get today might not be available in 6 weeks. The business line of credit your company has been considering might get pulled or repriced. Lock in your financing while the system is still functioning relatively normally. Consequence 3, monitor the ex-date estimates. The Treasury Department publishes updates on the TGA balance and the estimated ex-date. As of late January 2026, they are estimating the ex-date falls sometime between late March and mid-April. But these estimates can shift. If tax receipts come in weaker than expected, the date moves earlier. If spending surges unexpectedly, the date moves earlier. Watch for Treasury announcements. When they say the X date is within 30 days, that is when the market will panic. Consequence 4, understand the political calendar. Congress is currently in session, but they have recesses scheduled. If they go on recess without raising the debt ceiling, the market will interpret that as a sign that a deal is unlikely. Stock prices will fall, credit spreads will widen, volatility will spike. The political calendar matters as much as the financial data. Consequence 5, the Fed's impossible choice. If the TGA hits zero and the government starts prioritizing payments, the Fed will face enormous pressure to intervene. They could expand their balance sheet to inject reserves. They could suspend QT. They could even explore extreme measures like buying treasuries directly from the Treasury, though this would be legally questionable. But any intervention that looks like monetary financing of the government will destroy the Fed's credibility. It will signal that the central bank is no longer independent. This could trigger an inflation panic. The dollar could collapse. So the Fed is trapped. Intervene and lose credibility, or stay out and let the system break. Here's the brutal truth. The TGA balance is a countdown clock. Every day that ticks by without a debt ceiling deal, the clock moves closer to zero. When it hits zero, the financial system faces a moment of maximum vulnerability. We are not just talking about a government shutdown. We are not just talking about missed payments. We are talking about a potential collapse of confidence in the US dollar, in Treasury securities, in the basic plumbing of global finance. The connection to video number 7 is now clear. The SOFR spike we analyzed was not a random event. It was a symptom of reserve stress caused in part by the TGA drawdown. As the TGA continues to drain, SOFR will spike again, and each spike will be larger than the last. We are watching a slow-motion liquidity crisis unfold in real time. In our next investigation, we are going to look at the derivatives market, specifically the interest rate swaps that are tied to SOFR. We have over $200 trillion in notional derivatives exposure linked to this benchmark. If SOFR becomes unstable, if it starts spiking and crashing unpredictably, the models that govern these derivatives will break. Margin calls will explode. Counterparties will fail. The 2008 crisis was triggered by mortgage derivatives. The next crisis could be triggered by rate derivatives. We will map the risk, identify the weak points, and explain what it means for your 401k and your pension. 3 things to watch this week. 1, the TGA balance. The Treasury publishes it daily. If it drops below $600 billion, the urgency is increasing. 2, congressional headlines. Any sign of a debt ceiling deal will stabilize the market. Any sign of gridlock will destabilize it. 3, SOFR prints. If we see another spike above 5.5%, it confirms the reserve drain is accelerating. Subscribe for investigations into the financial mechanisms that operate in the shadows. The Treasury's checking account is running dry, and when it hits empty, the system breaks.